You wake up one morning and the entire system you trusted is gone. Your bank is still standing. Your money is still there. But somehow, nothing works. People stop lending. Businesses stop hiring. Homes lose half their value overnight. And the strangest part, almost no one can clearly explain what just happened. That was 2008. And if you zoom out far enough, it wasn't just a crisis. It was a chain reaction, quiet, slow, almost invisible until it wasn't. So let's rewind, not to Wall Street, not yet. Let's start somewhere simpler. Imagine a small neighborhood. There's a house on the corner, nice, not fancy, worth, let's say, $100,000. A family buys it. They don't have $100,000, of course. So they go to a bank. The bank says, sure, we'll give you the money. Just pay us back over time with interest. That's a mortgage. Simple. The bank takes a risk. The family makes payments. Everyone wins. That's how it's supposed to work. Now here's where things begin to shift, because the bank doesn't just hold that mortgage. It sells it to someone else. This might sound strange, but it's normal. The bank bundles hundreds, thousands of mortgages together and sells them as a package to investors. These packages are called mortgage-backed securities. Think of it like this. Instead of one family paying one bank, you now have thousands of families paying into one giant pool, and investors buy slices of that pool. If people keep paying their mortgages, investors make money. Stable, predictable, safe, at least. That's what everyone believed. Now pause, because this is the moment the system quietly changes. Banks used to care deeply if you could repay your loan. Now they don't have to, because they're not keeping the loan. They're selling it, which means the risk moves. And once risk moves, behavior changes. Banks start asking a different question. Not, can this person repay? But, can we sell this loan? And the answer, for a while, is always yes. So lending becomes easier, then reckless. People with stable jobs get loans. Then people with shaky income. Then people with no income verification at all. These are called subprime loans, risky loans. Loans that, under normal circumstances, should never have been approved. But they were, because the machine needed more fuel. More loans meant more packages. More packages meant more profits. And more profits meant no one wanted to stop. Now let's add one more layer. Investors buying these mortgage packages want reassurance. They want to know, how safe is this? So rating agencies step in. They look at these bundles of mortgages and assign ratings. AAA means very safe. And here's the part that still feels surreal. Many of these bundles filled with risky subprime loans were given top ratings. AAA, why? Because the structure was engineered. The riskier loans were mixed with safer ones. Losses were assumed to be rare. Housing prices were assumed to keep rising, always rising. That assumption becomes everything, because if home prices keep going up, even bad loans don't look so bad. If someone can't pay their mortgage, they can just sell the house at a higher price. Problem solved. Except that only works if prices never fall. Now zoom out. You have banks creating loans they don't keep. Investors buying products they don't fully understand. Ratings that say everything is safe, and a belief shared by almost everyone that housing prices can't go down. It's not chaos, it's a system. And it's working until it isn't. Around 2006, something subtle changes. Housing prices stop rising, not crashing, just the slowing, then flattening, then dipping. At first, no one panics, because small drops aren't unusual. But for subprime borrowers, the ones already on the edge, this changes everything. Remember the safety net? If you can't pay, just sell. That only works if the house is worth more than the loan. Now it's not. So people start defaulting, quietly at first. Missed payments, foreclosures, then more, then faster. Now those mortgage-backed securities, the big pools of loans, start to feel pressure because the money flowing in is shrinking. Investors who bought slices of these pools start asking questions. How bad is it? And the answer is unclear, because the products are complicated, opaque, but layered. No one knows exactly where the risk sits. And when people don't understand risk, they assume the worst. Trust begins to erode. And this is where the crisis stops being about housing and starts becoming something else. Banks don't trust other banks anymore because they don't know who's holding toxic assets, so they stop lending to each other. This is critical because banks rely on each other for short-term funding. It's like oxygen in the financial system, and suddenly it's gone. Credit freezes, not just for banks, for businesses, for consumers. Everything slowed. It didn't start with banks collapsing. It started with people doing exactly what they were told. Buy a house, it's safe, prices always go up. And for a while, they did. So here's why this still matters. Because the same pattern, easy money, rising prices, blind confidence, keeps showing up again and again, just with different names. Now imagine this. You want to buy a house, but you can't really afford it. No problem. The bank says yes anyway. Low income? Fine. No savings? Still fine. No proof you can repay? Somehow? Also fine. These were called subprime loans, risky loans, but they didn't feel risky at the time because here's the trick. The bank didn't plan to keep your loan. They would take your mortgage, bundle it with thousands of others, and sell it to investors, like packaging risky debt into a shiny box and labeling it safe. And the ratings agencies, they stamped those boxes with AAA ratings, the highest level of safety. So now, pension funds, big institutions, even governments were buying them. Everyone thought they were holding something solid, but underneath, it was built on people who couldn't actually pay. Now add gasoline. Interest rates were low. Money was cheap. So more people borrowed, more loans, more houses. Prices kept rising and rising and rising. At some point, it stopped being about homes. It became about flipping houses for profit. Buy, wait, sell, repeat. The system looked unstoppable until one small thing changed. Interest rates went up. Suddenly, those cheap loans weren't cheap anymore. Monthly payments jumped, and the people who were barely holding on started to break. Missed payments, defaults, foreclosures, and now the illusion cracks because those safe investment packages, they were filled with failing loans, so their value dropped fast. Banks stopped trusting each other, lending froze, liquidity vanished. It's like the entire financial system suddenly realized it didn't know what anything was actually worth. And when trust disappears in finance, everything follows. Major banks collapsed, markets crashed, trillions of dollars evaporated, all from one uncomfortable truth. The system made more money by ignoring risk than by managing it. Think about that. Every step of the chain, brokers, banks, rating agencies, investors, got paid more by saying yes than by saying this is dangerous. So that's exactly what they did. And here's the irony. The people taking the biggest risk often weren't the ones who paid the price. Millions lost homes, jobs disappeared, entire economies slowed down, but the system itself, it survived, rebuilt, moved on. Now zoom out. This wasn't just a housing problem. It was a trust problem, an incentive problem, a blindness disguised as confidence. And the uncomfortable part? Those ingredients haven't gone away. Easy money still exists. Complex financial products still exist. And human behavior hasn't changed. So the real question isn't, why did 2008 happen? It's this. If the system rewards risk when things are good, what makes us think it won't do